Unless you've been hiding under a rock, you know we're on the brink of a recession. But this one is different and likely to be bigger and last much longer. Inflation's hitting a 40-year high. The Fed's been forced to hike interest rates to respond, and asset prices are collapsing, especially in high-growth tech, where we've had an unprecedented run of easy money, funding companies at 100 times revenue. And, by the way, there's a war in Ukraine with hints of nuclear escalation. It's getting pretty ugly out there. So what to do if you're a startup founder, investor, or employee? Yes, we're in for one of the most intense periods of our lifetime, but it's not all doom and gloom. There's actually 5 things you can do to not only survive, but thrive in the coming storm. But first, check out this message from the CEO of Uber. One of the most difficult things to do as a leader is delivering tough messages that face the harsh reality head on, but also inspire at the same time. And I love the way that Dara uses a crisis as a way to reinforce Uber's values, saying, "This will not be easy, but it will be epic. Remember who we are. We are Uber, a once-in-a-generation company that became a verb and changed the world forever." This is a rallying cry worthy of a Russell Crowe movie. History's taught us that CEOs that decisively change course to wartime leaders will emerge stronger for it, even if some of those decisions are hard. Okay, so the first thing to figure out is what your business has to do to survive. There's this misconception that you suddenly have to become default alive, meaning your business could survive even if you didn't raise another dollar of capital. The vast majority of startups, especially at the early stage, are not cash profitable right away. So I think this is an unrealistic option for most startup companies. And indeed, this is why venture capital exists as an industry in the first place. So in my opinion, it's more useful to think about what it takes to be fundable in this new market. In the past, it was all about how fast you were growing, almost no matter the cost. But now you need to be growing quickly, at least doubling year over year, and doing so efficiently, adding about $1 of net new revenue for every dollar you're burning at the company. So if you burned $1 million last month, you should ideally be adding $1 million of new revenue over the same time. I personally prefer substituting in contribution margin for revenue, which is basically going to be the same if you're a 90% margin software business, but it does factor in if you are a lower margin business. There's other things that matter, of course, like your market size, competitive dynamics, your team, how recurring your business is, and so forth. But at the end of the day, if you hit the 2 metrics I mentioned, the fundamentals of your business are likely clicking and you're probably fundable. But there is one complication here. A lot of companies raised at massive valuations already, which might make fundraising even harder. 100 times revenue was common for SaaS businesses during the peak of the bubble. And some companies like Fast raised at near billion-dollar valuations with just $1 million in revenue. A lot of these companies are naturally hoping to avoid the pain of a down round. For them and many others, a useful exercise is to figure out what it would take to raise at the same valuation that you got in the past. There's 2 ways to do this. The first is to discount your revenue multiple by the same drop you've seen in the public markets since your last raise. For example, public software SaaS valuations dropped from 12 times forward revenue to 5 times, an almost 60% decline from the peak. Fintech and consumer internet companies are down over 80%. Downturns impact different sectors unequally, so it's important to look at the right business comparisons for your business. The second, more conservative and probably better way to do this, especially if you did raise at 100 times multiples, is to just take the public market multiples and give yourself a 50 or 100% growth premium, assuming you are doubling or tripling every year in a capital efficient way. When you actually go through this exercise, it can get scary fast. Let's say you raised at a $2 billion valuation for your $20 million revenue business. If investors would value at double the public market price at 10x forward revenue, then you'd still have to get to say 100 to 120 million in revenue with a path to 200 million in the next year, 10xing the size of your business, just to raise a flat round. That's a super daunting challenge, so it feels inevitable we're going to see a bloodbath of tech unicorns in the coming few years, where many or even most of them don't make it out alive. At least not without a massive down round. Okay, so now that you figured out what milestones you need to hit, you need to model out a few scenarios to see if you can realistically get there. What would happen if sales dropped due to the recession? How might you offset that by cutting expenses? And remember that you can't wait until the end of your runway to fundraise. 2 years of runway is really only 5 to 6 quarters because it could take another 2 quarters or more just to fundraise and close. So let's say you're in the same boat as many startups where it's going to be a stretch to hit investable milestones. Well, the good news is there's tons of things you can do to buy more time to get there. As Darwin once said, it's not the most intellectual of species that survives, and it's not the strongest that survives, but the one that is able to best adapt and adjust to the changing environment. So how does a startup adapt? Usually the biggest piece of a startup's burn is people. In the past, hiring was the best way to hit aggressive growth targets, regardless of the cost. and companies became unnaturally bloated. In this new normal, it's important to figure out where can you trim expenses and headcount without cutting into the bone. Often, financial constraints can actually force companies to right-size in a healthy way and become more creative with the resources they have. This can be a great time to potentially stretch dollars by offshoring engineers. If you do layoffs, just make sure that you cut deep once so that employees aren't in a constant state of fearing for their jobs. It maybe goes without saying, but make sure you take care of your people with severance packages and help in finding new roles, and reward those that stay on. The second biggest source of startup spend is OpEx. In the past, with money being plentiful, many companies had experimental budgets to test new marketing ideas or hire more engineers to build more speculative products. But in a downturn, companies are going to have to double down on what's truly essential. Marketing, in particular, is a great place to start cutting out low ROI, slow payback channels like PR or brand marketing. More generally, don't overinvest in customer acquisition until you truly know the long-term LTV and unit economics. And beware of selling into startups right now, because that's a customer base that's going out of business left and right. Selling to big enterprise is the much safer bet. Offer discounts to your customers for paying invoices sooner and for paying contracts upfront so that you can get cash in the door quickly. Cash is king in times like this. It may be obvious to say, but the free massages and buffets may have to go away too. Every perk is another dollar your company needs to make back. And the last thing you need to do is pass around the hat to your inside investors or find strategics, angels, anyone who will help top off your round and extend runway immediately. Now is not the time to get cute on valuation. During the pandemic, Airbnb pivoted to longer-term stays as people weren't traveling for short-term trips anymore, and DoorDash had 2 painful down rounds. If, after all of this, your business still isn't fundable and you have less than 12 months runway, you have to start developing relationships with potential acquirers right away. Those conversations take a lot of time. A lot of acquirers take 6 months just to get to know companies, and then we'll spend another quarter just on diligence. And expect fewer soft landing talent acquisitions, since the market is going to be flooded with talent and distressed companies at times like this. Given the limited timing, a lot of companies may need a parallel process: fundraising, acquisition conversations, and working with a banker to find non-traditional sources of funding that may flip into acquisition conversations as well. But beware of some of these M&A and fundraising deals potentially falling through even after term sheet or being renegotiated at the last minute during rough times. When you do fundraise, make sure you're picking lead investors with sufficient capital, reserves, and LPs that are resilient, meaning long-standing institutions like university endowments, and not money from Saudi Arabia or wealthy individuals that could disappear overnight. And avoid party rounds or investor syndicates where no one would step up if things went badly. But beyond just surviving, there are chances for companies to go on offense as well. When financing gets hard, a lot of other things become easier. Recruiting, in particular, gets simpler when big tech companies in your competition is freezing hiring. If there's one stretch hire that you couldn't land that could really change the trajectory of your business, as long as you can afford them, now is a great time to try to shake them loose. Customer acquisition can also be easier when there aren't a million other competitors bidding up the same Facebook and Google ads. If you have a structural advantage to make more money than others from new customers, now may be a great time to grab market share. There's also going to be less copycat competitors rushing to do exactly what you're doing just to make a quick buck. For companies that are lucky enough to have cash, now can be an amazing time to consolidate markets and buy up smaller competitors on the cheap. And lastly, anticipate changes to your customers and partners. Although willingness to pay for the same product may drop, there may be chances to solve other problems that have become more important, like cutting costs or helping them deal with layoffs. In a recession, the most valuable products help customers turn cost centers into profit centers. Figure out what has become the new #1 anxiety for your customer and help them fix that. And the same goes for partners who might be more willing to work with you now if you can band together and help accelerate each other's sales. Okay, what about advice for investors during a downturn? Before you click away, if you're a founder or startup employee, it turns out the investor lens is actually essential for you too. In some ways, it's even more important because while investors can fund a portfolio of many companies, employees and founders can only choose one company to invest years or decades of their lives into. A lot of new investors who've never been through a downturn before are naturally not going to appreciate how bad things can get. So there will be the occasional startup that still raises at ridiculous prices, but a lot of these investors will cut their hands catching falling knives as the market keeps crashing. The wiser thing to do is to preserve capital, as there's going to be tons of opportunities in the coming year, and those with the cash to invest will be in a great spot. That doesn't mean don't do any deals, but now that investors aren't just throwing money at any founder with a pulse, there's the time to actually diligence companies and make better decisions. Avoid the kind of high growth, high burn companies that used to be hot, but are going to get absolutely torched in this market. And instead seek companies with more capital efficiency and a clear path to profitability. Fund must-have products, not nice-to-haves. And avoid backing companies that only sell to other startups. That used to be a great formula for high growth, but is at huge risk going forward. When you do make an investment, you'll have to reserve more for the future to ensure the company has the runway to survive. You also have to work closely with founders to help them adopt the wartime mentality that we talked about. Opportunistically, there may be chances to invest in the absolute best companies on your wish list, whereas it maybe wasn't an option before. A lot of these companies may have never been willing to take more money in the past, but are now willing to stockpile more money. If you're an early stage investor, you may be surprised to see some later stage investors introduce structure that you've never seen before, like liquidity and senior preference to deals and larger option pools. Don't get too surprised or too angry. In the past, investors with massive funds were greedy about deploying as much as they could, so they would often elbow out other funds and take the entire round for themselves. But now, expect more investor collaboration and co-led rounds as money runs short. If you're participating in that kind of round, you gotta diligence the other investors. Ask about reserves and their LPs, as you don't want to be left out to dry as the only one left to fund the company when things go bad. While it's easy to be doom and gloom, it's important to remember that the most iconic startup companies today, whether it be Airbnb, Snap, or Uber, were all built during the last 2008 financial crisis. The journey for some of these companies was hard, but ultimately the downturn proved to be a valuable crucible. So despite the tech implosion, the next couple years are going to be an amazing time to company build. And technology still remains the key to transforming archaic industries end to end and solving humanity's greatest problems, from healthcare to education to finance to climate change. Web3 is another movement that could change the world. Check out this video here or my channel to learn more. Thanks so much for watching. See you next time.